Well, so they were kind of hinting that they might start initiating language about still hiking, but at a slower pace. And I think that's probably on the table now. We did get a decent job report, a job opening report, and also we've had some Fed officials kind of walk back some of those dovish things and kind of reiterate a hawkish view. So maybe they go another meeting before they introduce that type of language. I think there's kind of a toss up there, but I think that with rates where they are and kind of the state of the economy, I do think that we're probably getting to a period where they're going to that the rate of change, the hawkishness and rate of change terms is probably peaking, even though in absolute terms they're obviously not at the rate that they want to get to and that the market's pricing for. So I think that that's going to be something to keep an eye on. And I think a longer term dynamic is really just to focus on the energy market because the U.S. is drawing down its strategic petroleum reserve. I think somewhat past the midterms, that's probably going to stop, or they could keep pushing it further. But there's obviously there's only so far they can draw that down. There was a lot of concerns about, say, stock valuations, how expensive they were. And I was saying, okay, this is, that's a legitimate concern. There are a number of highly valued equities out there. There's also some cheap ones. But I said the more remarkable thing is what's going on in the bond market, where, you had, mostly in Europe, you had a lot of negative yielding debt. And then you had basically zero yields in Japan. In the United States, we had, near zero on the short end of the curve, a little higher, when you go out. And so basically, it's super low yielding debt. Most of it was below the inflation rate. And the idea was that inflation's dead, it's never coming back. Was one thing I looked at from researching history is that normally when countries get very indebted at the sovereign level, so very large levels of debt relative to GDP, they kind of go past the event horizon where that debt is ever going to be paid back in purchasing power terms, right? And so obviously different countries, depending on their debt profile, will handle that differently. If you're an emerging market and your debt is denominated in a currency you can't print, like dollars, or if you go back long enough and some countries would have like gold reparations and things like that, they can't print those things, and so they could outright default on some of their obligations or restructure them, which is another way of saying default. Whereas if the debts are denominated in their own currency, normally it's through inflation, right? So it's financial oppression holding yields below the inflation rate, and the kind of the post-war era. In Europe it was the 20s, and in the United States and much of the world again it was the 40s, where a lot of that sovereign debt was eviscerated in real terms, and I started to see kind of a similar dynamic building here. And none of the risk was priced in my view. I think it's some of that's been priced better now, but I still think that, I mean, this has been a historic bond crash globally. Tens of trillions of dollars have been in paper wealth and wiped out of the sovereign bond market, let alone, the corporate bonds that are, all the other types of bonds that are kind of, associated with those yields at a higher level. And, going forward, say treasuries are less terrible looking than they were, but generally speaking, I think most sovereign paper wealth is not going to do very well in purchasing power terms, say, over the next decade. Ironically, the United States like dollar market, as big as it is, it's not really big enough to serve the whole world anymore. When this system was constructed with the dollar and the treasury at the core of the system after the post-war era, the United States was over like 40% of global GDP. It was kind of like the last country standing. And it had all the gold, it had all the military, and it had all the economy, the industrial capacity. And as things have been rebuilt, and then as multiple countries have risen in power, we live in a more multipolar world now, right? So the United States is closer to 20% of GDP, depending on how you look at purchasing power parity, will be less than that. If you look at nominal dollar terms, it's a little bit above 20%, but it's certainly, reduced its share of global economy, but it still has a very large share of that global payment and reserve volume. And I think it's kind of squeezing parts of the world out. And now, obviously, for geopolitical reasons too, but I think even before some of the events of this year, there was a recognition among multiple countries that they want to, diversify their payment and reserve, situation. But a general trend that we're seeing obviously is that gold's moving from west to east, essentially, right? So a lot of the physical gold is going to China, going to India, going to Turkey, going to Russia, as you pointed out, multiple countries throughout kind of Eurasia, the BRICS nations, and so there's that general migration of the physical metal, where some cultures have they either have the trade surpluses to absorb it, or their society values it more, views it as more of a store of value, whereas a lot of Western investors have somewhat lost interest in it, and a lot of the Western countries are running these deficits anyway. So there's this general flow, which kind of corresponds to the rise of power of Asia as an economic force in general, and so we are seeing kind of that those interesting dynamics in the gold market, and it's obviously been a long story where multiple people can think they have exposure to gold and not really have exposure to gold. Like if things really hit the fan, if you kind of put the cards on the table, who has the gold? A lot of people think they have gold, but if they actually were to all kind of call on those claims at once, some of them would be obviously left without it. And I think that the market is kind of going through that process to sort some of that out. And obviously that can have long-term implications about price, right? Because if you can increase the supply of claims without increasing the supply of the underlying, that can obviously be negative for pricing. Whereas if you have a kind of a truer perception of where the gold is and who owns it, that can be constructive for price as long as the demand is there. And so I think that's a trend we're seeing. And it's interesting because gold, obviously gold's had a rough year this year, but if you compare it to like long duration bonds, which is one of the closest things you'd compare it to, gold held up better than most long duration bonds did. So it was, it didn't go up like a number of people would have hoped, but it did some damage control in a portfolio or in a net worth. Yeah, and I think it also depends on the opportunity set of what else is out there, right? So if you're in an environment where multiple assets are very cheap relative to your assessment of how well they're going to do. So in other words, you have a high rate of return expectation on multiple types of assets. In that type of environment, then maybe people want a lower gold allocation. They want to go out into those, more generating type of assets, capital, to have a higher rate of return. Whereas if you're in an environment where multiple things are very highly priced. Like going back to sovereign bonds in 2019, I mean, negative yielding bonds or near zero yielding bonds. That's basically another way of, and if you have a sovereign bond yield with a 1% yield, it's kind of like saying 100 price to earnings ratio that is not going to grow but is super safe, right? And so does that sound attractive to people? Most people would say no. But then you say, well, what about a 1% yielding treasury? And back then people were like, yeah, that seems fine, or obviously zero or negative in many cases. And so in that environment where the opportunity set of stocks and bonds in general is unattractive in terms of forward returns, then gold becomes more attractive. And historically, if you look at things like the CAPE ratio, the cyclically adjusted price to earnings ratio of the S&P 500, as an example, during periods where it's highly valued, generally the next 10 years, stocks underperform gold. Whereas the inverse is true. If the CAPE ratio gets very, very cheap and you're able to actually get good dividend yields and good earnings yields and the basically the equities are underowned, then generally going for the next 10 years, they're likely to outperform gold. And so I think we're in that environment where it's not at some of the extremes like it was before, but I think the opportunity set out there is really challenging, especially for the S&P 500, these big tech stocks that I think are still somewhat pricey, as well as still looking at much of the global sovereign bond market, and I think that the opportunity set of gold is better than a lot of those over, say, a 5-10 year period going forward.